Good morning and welcome. You're watching Market Cafe on ET Now. That's Ankita Saxena and I'm Harsh Saita. We take you through all that's happening in global markets as well as global business news as well as domestic, both business news as well as corporate news. Tons of announcements on the back of earnings, of course. None of the major frontline companies in a big way, but at the same time, a lot of companies to keep a track of course, as you would understand. Right off the bat, let's try and understand what's happening in global markets. Ankita, talk to us.
So Harsh, the US markets were down on Friday because the consumer sentiment report really weighed on the markets. It didn't come out very well with the investors, and of course the consumer sentiments weren't as they were expected. The S&P 500 fell 0.1% as concerns around the US economy dampened the investor sentiment. A consumer sentiment report that came out on Friday, consumer sentiment index, fell to a 6-month low of 57.7 versus the estimate of 63. Now, the survey also showed the outlook for inflation over the next 5 years that climbed to 3.2%, trying the highest clip since June 2008, and it's well above the 2% target for the Fed. Now, the Dow Jones Industrial Average dropped 8 points, largely flat in trade, but ended the day in the red. The Nasdaq Composite fell 0.3%. Now, the S&P 500 and Dow fell for a second consecutive week, down 0.2% and 1% respectively. The Nasdaq Composite, however, was bucking the trend, gained 0.4% for the third straight week on the back of strong tech earnings that came in. And let's look at the European markets. European markets were bucking the trend, closed higher despite a downbeat week. The Pan-European Stock 600 closed 0.4% higher. Also, the UK's GDP report came out. UK's gross domestic figures showed 0.1% growth in the first quarter of the year, in line with the forecasts, but an unexpected 0.3% fall in March as the service sector contracted. DAX was up 0.5%, FTSE was up 0.3%, and CAC was up 0.4% in trade, Harsh.
Absolutely. So in line with that, when we're looking at crude oil prices and where crude is headed, we're seeing a bit of a soft close for crude to the end of last week as well as to the beginning of this week. So we're seeing a 0.5% odd plus cut in terms of crude prices. In fact, when I'm looking at WTI, it's below the $70 a barrel mark. We're seeing Brent below $74 a barrel. So, that's where crude prices are at. Couple of other moving parts as well. We're seeing the dollar index gain some amount of strength. So the greenback rose around 0.5% odd over the last few days. And what that has led to is, of course, pressure on crude. Both are inversely related, and ideally when the US dollar gains, we see a bit of a dampener of that impact on crude. So that's one piece of the pie. Of course, the other piece Ankita did speak about was the fact that there was a slower than expected, or rather there's a recession which is anticipated for the US, and that keeps a lid on crude prices as well. So couple of those moving parts keeping crude in check at the moment. WTI below the $70 a barrel mark, of course, a positive for countries like India, which are oil importing, Ankita.
All right then, Harsh, let's quickly go across and take a look at all the events that we need to keep a track of in today's week. It's going to be a buzzing week. Today, we are expecting the trade balance and the wholesale prices coming in for India. From the US markets, tomorrow, that is 16th of May, we have the industrial production data and the initial jobless claims that will be coming out on the 18th of May. Also, tomorrow we have the UK jobless claims that will be coming out. Again, tomorrow we also have numbers coming from China's industrial production. Also, back home, let's look at the earnings calendar. We have tomorrow we have Bharti Airtel's earnings that will be closely watched, and we have the State Bank of India and ITC that will be coming out with their numbers on the 18th of May. And we have JSW Steel and NTPC and Power Grid that will be coming out with the numbers on the 19th of May, and we have the big IPO action happening on the 19th with Nexus IPO that will be listing on the bourses.
Well, absolutely, keeping an eye out on all of those through the week, but let's quickly move on. In the latest on the US debt ceiling front, US President Joe Biden has said He wants to meet with congressional leaders to extend talks on raising the debt ceiling and thereby avoid a catastrophic default. The said meeting was earlier scheduled on Friday last week, which is now set to take place sometime tomorrow.
And in some other significant news flow that we are tracking this morning, Ukraine's President Volodymyr Zelenskyy met with the Pope Francis on his single-day trip to Rome. In the 40-minute meeting, Zelenskyy asked the Pope to back Kiev's peace plan. Meanwhile, in response, the Vatican has indicated that it would help in repatriation of Ukraine's children taken by Russians.
And shifting focus to Turkey, where people are voting to choose their next president. A landmark election in the country's history, as current President Erdogan is faced with the biggest power challenge in over 2 decades. Latest figures as per state-run news agencies suggest Erdogan is logging under 50% and his opposition is marking an over 44% lead. If neither win a majority, they will go to a runoff, a first for Erdogan.
And staying with electoral activity across nations, and now Thai voters have rejected the military-backed government as 2 opposition parties appear to be set for coalition talks. This election has been described as a turning point for the country, which has experienced military coups in the recent years. The reformist opposition has won most seats and the largest share of the popular vote in a stunning rejection of nearly a decade of military-backed rule.
Well, the verdict is out. The Congress has returned to power on its own strength in Karnataka with lead in 137 of the 224 seats after a 10-year gap. Let's hear out what Congress leaders, including Rahul Gandhi, had to make of the victory.
सबसे पहले मैं कर्नाटक की जनता को, कर्नाटक में कांग्रेस पार्टी के सब कार्यकर्ताओं को, सब नेताओं को और जो हमारे सब नेताओं ने कर्नाटक में काम किया, उनको बधाई और धन्यवाद देता हूं। कर्नाटक के चुनाव में एक तरफ क्रोनी कैपिटलिस्ट की ताकत थी, दूसरी तरफ गरीब जनता की शक्ति थी और शक्ति ने ताकत को हरा दिया। और यही हर स्टेट में होगा। कांग्रेस पार्टी कर्नाटक में गरीबों के साथ खड़ी हुई, हम गरीबों के मुद्दों पर लड़े और मुझे सबसे अच्छी बात यह लगी कि हमने नफरत से, गलत शब्दों से ये लड़ाई नहीं लड़ी। हमने मोहब्बत से, प्यार से, दिल खोल के ये लड़ाई लड़ी और कर्नाटक की जनता ने हमें दिखाया कि ये देश मोहब्बत इस देश को अच्छी लगती है।
कर्नाटका ने इस देश को साबित कर दिया है कि ध्यान भटकाने वाली राजनीति अब नहीं चलेगी। कर्नाटका की जनता ने अपना ध्यान एकदम केंद्रित रखा, अपने मुद्दों पर रखा और ऐसा निर्णय लिया कि जो वहां पे जो भ्रष्ट सरकार थी उसको निकाला गया।
All right, a big win coming in for Congress in the state of Karnataka. And with that, it's time for us to slip into a short break. Don't go anywhere. We get you more domestic news on the other side.
Welcome back. You're watching Market Cafe on ET Now. We've spoken to you about all that's happening in the global marketplace, but let's quickly look at what's happening in the Asia markets. We're looking at the Shanghai, which is down around 0.25%, largely in line with the way the US markets have performed as well as European markets have performed. So we're seeing a bit of a docile start when it comes to some of these markets. We're looking at the Kospi also lower in early trade. we're seeing the Nikkei, which is up around 2/5% in early trade as well, and we're seeing largely the Hang Seng also flat but slightly lower, a negative bias coming in for the Hang Seng. Now mind you, the Asian markets are mixed. It's the second consecutive week where Wall Street has clocked losses, and that is really cascading on Asian markets as well. The SX 200 also down around 1/5%. So largely negative. What we're seeing on the SGX Nifty is that it's indicating a slightly negative start as well, 1/5% low, around 40 points down is where we are looking at the index, at least at the moment.
Right, Harsh.
Welcome back. You're watching Market Cafe on ET Now. Now, one of the key pieces that is moving global markets is inflation at the moment, and India's CPI print for the month of April seems to mean that inflation seems to be cooling down. The headline inflation came in at 4.7%, which is a significant cool off since March and within RBI's tolerance limit of 2 to 6%. Now, core inflation too came in down at 5.2%. This is on the back of a softening of food prices, lower energy prices as well during the month of April. The industrial production too came in down at 1.1% from 2.2% last year, and the RBI Governor Shaktikanta Das says that the number is indeed very satisfying. My colleague Maithili Bhusnarma shares her take on this particular piece.
Well, this evening, the government and the RBI finally got some good news on the inflation front. The good news is for the month of April, inflation has come in a little below estimates. It's come in at 4.7%. This is the first time it's come in below 5% for close to 20 months, and that is certainly good news, prima facie. Why do I say prima facie? Because the decline in inflation is primarily because the base effect. That means the inflation number in the same period last year, in April 2022, was 7.8%, the highest in 8 years. And since inflation is measured in comparison to what it was in the previous period of the year-ago period, it seems to have come down dramatically to 4.7%. But the fact is that it does show a declining trend because the base effect has been there for the past few months. Combined with this, another good piece of news is that food inflation has come in at 3.8%. So two pieces of good news. Of course, we take away a little bit from that because of the high base effect. And going forward, we're not very sure whether the trend will continue for two reasons. One, because of the El Nino effect. One doesn't know how it's going to impact. The monsoon is going to impact the monsoon, and how the monsoon in turn will impact food prices, because food constitutes close to 50% of the consumption basket. Then, of course, we have the uncertainty on the oil front. One never knows which way oil prices will move, and that again has a huge impact on our prices, over which the RBI has no impact at all. But for the moment, it does seem as inflation seems to be under control. The RBI's estimate for this quarter was 5.1%, and as of now, the first month of the quarter we seem to be getting there. So that's a good news as far as inflation is concerned. Of course, we have to take this with the minus news as far as IIP is concerned. Index of industrial production has come in way below estimates at just 1.1%. So some good news and some bad. But certainly, given the fact that inflation has been the more worrisome factor, we have the good news must count for more as of now.
All right, then good news coming in on the inflation front for India. Now let's go across to Governor Shaktikanta Das, who also shared his views on the CPI print.
Very satisfying to note that the consumer price inflation, last month it was that is in the month of March, which data was released in April, on April 12th. The consumer inflation, the headline inflation was 5.7%. And the inflation number for April, which was released today, was 4.7%. So it gives me and my colleagues in the Reserve Bank to say with reasonable amount of confidence, in fact, I would say with good amount of confidence, where we stand today, the country's GDP is expected to have grown by 7% last year, 22-23. Current year, 23-24, we have given a projection of 6.5% from the RBI. And we are quite optimistic and fairly confident that the actual growth will be close to that. Although international agencies like the IMF have given lower projections, but we have sort of shared our thoughts with the IMF, and we are reasonably sort of optimistic and confident that the growth will be close to 6.5%.
And we'll stick to that comment from the RBI governor. We'll stick to growth because during an event, Tata Sons chairman lauded the India growth story, saying that the country has the best talent available on the digital front and can achieve much more in the supply chain ecosystem. Listen to what he had to say.
Unique opportunity for India for multiple reasons. There are 3 transitions and there are moving geopolitical situations. From the transitions point of view, the first is digital and AI, second one is energy, third one is supply chain. In all the 3 transitions, I would say that India is probably the best placed country in the world. First, on the digital, just 2 primary reasons. First, there is no country in the world which has demonstrated a large-scale digital intervention and digital platform for public services delivery, which is transformative at scale. I think, everyone who has lived abroad in any country or has done business anywhere, whether it is the UPI, whether it is the Aadhaar, whether it is Jan Dhan Yojana, you can go on and on. The second thing on the digital side is, it's no secret that we have the best talent available from a digital point of view for the future. And the scale and the depth that India has, again, is unparalleled. You can add all the talent that's available from next 10 countries, still they will fall short. So these 2 are big tailwinds. If you take the energy transition, India is probably the only country in the world which has to achieve the energy transition purely only accounting for growth. Most other people, whatever be the country you take, their energy transition to renewable or new energy, what have you, has to be substitution. The third thing, whether you call it this country fix, that country fix, doesn't matter. To my mind, the global supply chain is going to be rebuilt. And it is being rebuilt as we speak. It is not that it is going to happen, it is happening. We are in the middle of that. Sometimes you don't realize when something is happening. You always connect the dots backwards.
All right, then moving on, G20 Sherpa and former CEO of Niti Aayog remains bullish on India's growth story. Now says that the country is poised to see robust growth with massive contribution from the private sector. Listen in to what he had to say.
Private sector is the key. The book is based on the fact that private sector should drive India's growth story. The government has to be just a facilitator and a catalyst and a coherent policy maker. In the long run, India's growth story has to be totally driven by the private sector. That's my belief.
And sir, according to you, what would be the challenges? Because you said that India is poised to grow.
A lot of structural reforms have been carried out. We've done a huge amount of reforms in terms of GST, IBC. We've digitized our economy. We've done decarbonization. So this is the opportunity for the private sector to leapfrog and go ahead technologically, make a quantum jump forward.
Right, but one particular group which was in focus over the last week or so is Adani Group, and tracking the news flow on a couple of those Adani Group companies which will be in focus today. The boards of Adani Enterprises and Transmission have approved plans to raise as much as 21,000 crore via QIP. This comes within months of the scathing report by short seller Hindenburg. Let's shed some more focus on the breakup. Flagship company Adani Enterprises will raise as much as 12,500 crore, bulk of that 21,000 crore. And meanwhile, Transition will raise around 8,500 crore. What's left now is a shareholder nod for the plan, and meanwhile the news flow doesn't end here. The final hearing in the top court today over the Adani Hindenburg row, which is in fact expected to see a 3-month extension. Some positive news flow as well. Adani Total Gas, Adani Transmission and Green Energy trade outside the ASM framework from today. So keep an eye out on the entire Adani group.
That's right. We will be keeping an eye out on the entire Adani group, Harsh. Moving on, SBI MD CS Shetty tells ET Now that the bank is awaiting final guidelines on ECL provisioning. Mr. Shetty also says that LCR is helping the banks. Listen in to what he had to say.
One important and very positive thing which is happening in the bank industry now is that we are seeing a very good credit growth. I think in 22-23 has been a phenomenal year in terms of the banking credit growth, and many of the banks have witnessed a double-digit credit growth. And while the first half of the current financial year, as you know, probably would witness a lower credit growth, what was significant to note that the deposit growth rate has been a little lower than the credit growth rate. But why the capital expenditure and the government expenditure picks up and the money flow into the economy happens, we all believe that the deposit growth rate also will come back. So with that, the banks would be able to support the estimated credit growth, what is going to happen. I think
Right.
There's a point which I was trying to make.
Right. But you also mentioned about how banks should utilize the opportunity of maintaining the regulatory requirements, and they will benefit from the same.
Yeah. So, see, the context which I was mentioning is in terms of the liquidity coverage ratios. And while the regulatory mandate is just about 100%, most of us always create liquidity cushions. We don't want to create a situation where the banks get into the liquidity position, and that prompts the banks to hold a little more G6, which qualify for the high quality liquid assets. And I think it's a good strategy that I see that banks across the banking industry maintain healthy LCRs. That is very important. And a bit of this excess SLR which we have been maintaining has been supporting the credit growth in the absence of the larger deposit growth rate.
Right. Sir, one of the concerns for the whole banking industry in recent days has been the new circular which is yet to come from Reserve Bank of India on expected credit loss provisionings. How much impact do you see as an industry there will be after this circular is finalized and implemented?
So as you said, it is yet to be implemented. I think we need not jump on that. But I think as Mr. Srinivasan of Federal Bank has mentioned, directionally it is a good move. I think let us see that there will be uniformity of assessment of the credit losses, both in the NBFC sector as well as banking sector. That I think will be uniformly maintained.
Right, interesting conversation there my colleague Ankur having with the SBI MD. But let's quickly move on. Automaker Tata Motors reported its numbers. Revenue jumped to over 1 lakh crore rupees for Q4. The company also managed to pare its losses from the year before. The management remains optimistic on the demand situation as well. Srishti, who tracks the sector, is here to tell us more about the company as well as the quarter gone by. Srishti, break the numbers down for us.
Well, a great set being reported by Tata Motors in a quarter gone by. Not just that, this was followed by a strong management commentary when it comes to their debt reduction plan as well as the free cash flow generation. Talking about the numbers, the company reported a profit figure of 5,400 crores. That is exceeding the expectation of 4,300 crores. Well, in terms of the revenue, EBITDA as well as the margin on a consolidated basis, they have come in line to the ET Now estimate with the margins of 12.1%. When it comes to their JLR division EBIT margin, there we have seen an outperformance versus 6% of expectation. The company delivered a 6.5% on that number. Talking about their JLR division, the guidance remains strong, where they say that the investment spending is expected to be £3 billion for FY24. The free cash flow generation is expected to be over £2 billion for FY24, as well as the net debt is expected to reduce to less than £1 billion, and that will be in rupee terms 10,000 crores from current 30,000 crores of net debt for their JLR division. For the India division, the net debt now stands at a 15-year low at just 620 crores, and the company has guided that in this financial year itself, you can see the net debt being zero for their automotive division. When it comes to their dividend play, a key to watch out for, the final dividend has been announced at 2 rupees per share and 2.1 rupees per share for their DVR shareholders, and that's what the management commentary is like. Going ahead, they are optimistic on the demand, so strong set by Tata Motors.
All right, then strong set of numbers coming in for Tata Motors, and on the back of that we have brokerage notes coming in. Now the first up is the view coming in from Nomura. Now Nomura has maintained a buy on the stock. They have also hiked the target price from 610 to 610 from 508 rupees per share. Now according to them, the Q4 results were broadly in line with their expectations, and they also see the margins to trend up across all the segments for Tata Motors. They also see that debt reduction will be a key catalyst for the stock. Now moving on, CLSA also came out with its view, and it has maintained a buy on the stock. Now they have also hiked the target price to 624 rupees per share from earlier 544 rupees per share. Now according to them, JLR has reported a significant improvement in the Q4 business. They also see a double-digit margin that has been achieved in the commercial vehicle business as a big positive, and in the passenger vehicle business as well, it is gaining a lot of market share, and that has come in very positively for Tata Motors according to CLSA.
Right, let's speak about what Vedanta had to say actually on their con call. Vedanta saw a strong overall quarter in terms of growth, even though its profit was impacted by a one-time exceptional item which was already largely priced in. The management continues to believe that Hindustan Zinc and the deal will be value accretive for both parties. Right, welcome back. You're watching Market Cafe on ET Now. Let's quickly go and check out what's happening with regard to all the major stocks that are in news. And we have Ansh, my colleague, who's going to take us through all of those stocks. Ansh, firstly, many congratulations on debuting. And secondly, talk to us about all the stocks that are in news.
Thank you, Harsh. Hi, good morning. So, Rail Vikas Nigam will be the first stock in focus for today's trading session, as the company and SSC Infrastructure has received letter of award for planning, designing and construction of main canal and structures. The project cost for which is 2,249 crores, out of which RVNL share is 51%. Apart from this, Dr. Reddy will also be in focus, as the company has received 4 observations from US FDA for the Andhra Pradesh plant. Let's have a look over a few important earnings on a year-on-year basis. Manappuram has reported NII of 1,125 crore, which is up by 25%, whereas PAT at 415 crore, which is up by 59%. Colgate has reported revenue from operations at 1,350 crores, which is up by 4%. However, the PAT has reduced by 2% at 500. Colgate has reported revenue from operations at 1,350 crore, which is up by 4%, whereas PAT at 316 crore, which is down by 2%. DLF has reported revenue from operations at 1,456 crores, whereas PAT at 569 crores. Back to you.
All right, Ansh, thank you so much for all those details. We will be keeping an eye out on all the stocks that you just mentioned, but we also have the brokerage notes coming in, and for that we have Vamakshi in the studio with us. Good morning to you, Vamakshi. Vamakshi, tell us, what are the brokerage notes saying this morning?
Well, a very good morning to both of you all. Let's first start off with Lupin. We have a brokerage note that has come in from Morgan Stanley. and they highlighted that the core business for Lupin has now started to show margin improvement from a low base. Visibility of high quality new launches are also being seen for generics such as Spiriva. FY24, in fact, in their opinion, could be a turnaround year for Lupin. So given all these factors, Morgan Stanley has in fact upgraded its rating on Lupin from equal weight to overweight, and in fact also hiked their target price from 717 to around 918 per share. HPCL is the next one on our radar. We have a note that has come in from Jefferies, and they highlighted that the company has reported better than expected refining. Marketing, however, missed their estimates. Refining weakness is transitory, and in fact, they're also seeing that there are some early signs of recovery visible out here. They see a possibility of a price cut to come in diesel, gasoline before key state elections in December. So overall, given all these factors, Jefferies has actually maintained an underperform rating on HPCL, but nevertheless hiked their target price from 190 per share to 205 per share. And lastly, keep an eye out on Dr. Lal Path Labs. We have two brokerage notes, one from Morgan Stanley, the other one from Credit Suisse. Morgan Stanley has maintained an equal weight rating with a target price of 2,214 per share, while Credit Suisse has maintained its underperform rating, but nevertheless hiked the target price from 1,500 to 1,600 per share. Morgan Stanley believes that the industry dynamics are improving. They're expecting return of double-digit volume growth as well as low single price increase. On the other hand, Credit Suisse believes that the near-term growth could be aided by geographical diversification as well as higher pricing, and however, they've stayed underperformed owing to the declining trajectory of its EBITDA margin.
Right, thanks for that, Vamakshi. Let's shift focus to the defense pack, where a fourth positive indigenization list has come out, which would promote import substitution of items worth 720 crore rupees. Vamakshi, talk to us about the PSUs which will be in focus, as well as about products.
Well, absolutely. So now with the fourth indigenization list, it includes actually 928 items, and this in turn could promote import substitutions of items that could be of around nearly 720 crores. This list mainly includes items that are used that in fighter planes, trainer aircraft, warships, as well as different types of ammunition. India imports, in fact, around 11,700 items, and out of which these positive indigenization list includes just 2,500 items, which is around 20% of the entire import substitution list. Now, out of 1,238 items from the first 3 PILs, 310 have already been successfully indigenized. So this is roughly the news flow that is surrounding the defense pack, and on the back of that, we will see PSUs whose items are actually listed on that list in focus. That includes the likes of BEL, Carbon Reach Shipbuilders, Goa Shipyard, Hindustan Aeronautics, Hindustan Shipyard, Mascot Dock, Mishra Dhatu Nigam, as well as Munitions India.
All right, then thank you so much for that, Vamakshi, and we'll move on then. It was a muted Q4 for Avenue Supermarts. Now, lower consumer spendings in general merchandise, apparel impacted the margins. Now, what else is ailing the Q4 numbers? Winnie joins in with just that. Over to you, Winnie.
So in terms of the numbers that we see for Avenue Supermart or D-Mart as we know it as, revenue obviously came in line because we have the operational update coming in. 10,337 crores is what the revenue came in at, a growth of 20%. Profits of the company, a mild growth of 8.4%, while the operating performance, that's where we saw a bit of a weakness coming in as well. EBITDA was only up by around 5%, while the margins, the EBITDA margins of the company have seen a contraction coming in of around 100 basis points, 7.6% versus 8.6%, and also that is below the expectations as well. So profit and the margins were a miss where we saw in terms of the numbers coming in from the company. Now, mainly what is impacting the numbers? Slower recovery, that is our impact coming in. Other than that, there's an adverse mix, more of the sales of the products other than like FMCG and staples, that has continued to be higher compared to the general merchandise and apparel category, which is impacting the margins of the company and overall in terms of the revenues of the company as well. So that lower contribution and lower adverse mix is something that is impacting the margins of the company. Other than that, they are also seeing a decline in terms of sales per square feet as well. That has also become lower, as well as store additions on the other hand has continued to remain strong. The company has added, store addition was robust, added around 40 stores in FY23. Keeping an eye out on that one, but all in all, as of now, the numbers were quite weak. Nuvama is is maintaining a hold rating, cut the target price to 3,913 rupees per share. Morgan Stanley maintaining an equal rate rating, target price at 3,853 rupees per share. They believe the negative is the weakness in the discretionary demand that has continued, so keeping an eye on that.
Right. Thanks so much for that, Vinny. Let's quickly move on. Mumbai-based online pharmacy PharmEasy's parent company API Holdings has seen yet another valuation markdown, this time by global asset management company Janus Henderson. Regulatory filings with the US SEC have revealed this particular piece. The global investor, which picked a stake in PharmEasy in September of 2021, has reduced the valuation of its holding in the firm by half, which would translate to an approximate valuation of around $2.8 billion as of 31st December 2022. The Temasek-backed e-pharmacy was valued at $5.6 billion when it closed its last funding round of nearly $350 million in October of 2021.
All right, then. HPCL has reported a strong set of Q4 numbers where PAT and margins both rised sequentially. Now, Samit is here with all the number crunching. Over to you, Samit.
Well, if you see in the fourth quarter, HPCL has reported a strong set of numbers. The EBITDA jumped nearly 3x compared to what the company reported in the last quarter, and this is mainly on the back of a stronger refining performance coming in from the company. If you see the company's gross refining margin, they stood at close to $14 per barrel level, which is way ahead of what the street was expecting. Also, the net profit growth was aided by higher other income and lower finance costs in the fourth quarter, and the company's gross debt that remained largely stable on a sequential basis. But the important announcement coming in from the company side is the fact that the company is looking to carve out the lube business and is also aiming to do a separate listing of the lubricant business going forward. Also, it is approved creating a 100% subsidiary for consolidation of all the green and emerging business opportunities under one umbrella. Now, this lubricant manufacturing demerger is a kind of positive announcement coming in for the company, because the lubricant business commands a higher valuation multiple as compared to what HPCL is currently trading at. Now, if you see, HPCL owns and operates the largest lube refinery in the country. Now, the lube refinery accounts for nearly 40% of India's total lube base oil production, and the annual sales from this unit stands at close to 0.6 million tons per annum. Now, it is the largest supplier to industrial segment, and in the consumer segment, it has a market share of more than 20%. Now, the company gained also around 250 basis points of market share in the financial year 2023. Now, HPCL's lubricant segment contributes an EBITDA of close to 1,200 crore rupees, and given what the peers are trading at, this the valuation of this company, or the enterprise value of this company, could be anywhere between 8,400 to close to 11,000 crore rupees, and this would mean that around 5 to 11% of its enterprise value could get separately listed, which is a positive point coming in for the shareholders. However, it will still take time because the government approvals and approval from minority shareholder is still pending on this thing.
Right, thanks so much for that, Somit. We'll move on. Venugopal Gare, who is the managing director at Bernstein, sees scope for financials to give positive returns and the contribution of financials to the index to improve further. Listen to his views.
See, but the reality is that financial sector is, waits, or rather the contribution to the index will eventually continue to improve through the year, because there is still certainty in terms of growth. And number two is certainty in terms of, their asset quality. Now, this is very, very different from what it would have been even 2 years back or 5 years back. I guess that will probably bring in a return of interest in financial sector as well, within the broader construct of credit growth, sort of being, let's say, in the 12-13% range, broadly from a system point of view for this year, lower than what it was at the fag end of the previous year. And more importantly, of course, NIM speaking and potentially seeing some correction. All that construct, yet I think there is still room for financial sector to sort of deliver positive returns this year. On healthcare, we are it's a smaller sector, so we typically take it bottom up, and that's why I never call it as an overweight or underweight. But yeah, we're marginally overweight that as well at this juncture, but we're taking stock by stock calls. That's the way I would look at it, and that's underperformed quite a bit, in the last 2 years as well, especially last year. So there could be opportunities, but remember, it has to be bottom up. I think it's very hard to take a top-down synchronous call in healthcare at this juncture, especially I'm talking about the pharma names. See, domestic facing, of course, there's always this positivity, and I guess that's an area where we still need to be positive on. The other two areas you mentioned, hospitals and diagnostics, look, those are more secular growth stories. So I guess there's nothing to it this year, even though we don't really have coverage on those names. So, no specific, allocations that we've done to that.
All right, then we are completely out of time on this one. Harsh and I will take your leave. Thank you so much for tuning in. Don't go anywhere. The markets will take the action forward.